If you were on vacation with your family, there was an email ban that was placed on you. You could not contact anybody at the company and vice versa. If you did, when you returned, you were asked to stand on the conference room table for a public shaming. When you're just starting out as an angel or even as a VC, you need to see a lot of deals. If you only see 10 deals, you might think 3 of them are great. If you see 1,000 deals, those initial 3 might not be so great. We're looking for motivated founders that are building because they feel like this is their life's calling or purpose at this point, and through their gifts and experiences and talents have led them on this journey that culminates in this startup venture. We believe that this overlap of faith-driven entrepreneurs with thriving cultures can deliver market rate returns and above market rate returns at that.
Welcome to the Diligent Observer from PitchFact. I'm your host, Andrew, and every week I share insights and strategies to help angel investors make better bets. My guest today is Phil Jung. Phil is a partner at Sovereign's Capital, where he invests in seed and Series A technology companies led by faith-driven entrepreneurs across the US and Southeast Asia. Phil was previously the CFO and CPO at Mindoula, a health tech company that serves populations with complex behavioral health, medical, and social challenges. Prior to that, Phil was with the Maryland Venture Fund. He was with Foundation Capital and with TDF Ventures, leading investments in early and growth stage technology companies. Phil began his career at KPMG's risk consulting practice in Silicon Valley, and he co-founded the Jeremy Lin Foundation, a nonprofit whose mission is to serve at-risk youth through education and leadership development in underserved communities. Phil, thank you so much for being with me today.
Andrew, thanks for inviting me on, and I look forward to this conversation here.
Likewise. Well, I have a lot of questions for you, but before we jump into those, my first one is about something that stuck out to me as I was reviewing your background. I saw on LinkedIn, way down to the very bottom of your bio, that you are a cello player. Is that right?
Yes. My main extracurricular activity growing up was playing the cello. So much so that I was actually part of the San Francisco Youth Symphony Orchestra during my high school years. And that was a big push to bolster a lot of my college applications as well. My mother was a classically trained pianist. She was the pianist in her church choir. It was really her influence early on getting me involved with music. My sister plays the violin. So yeah, the music runs in our family in that sense.
Do you still play? Do you keep up with it?
Unfortunately, I don't have as much time. I have 2 young kids, so I don't have much time to play anymore, but I still have a lot of that muscle memory. Yeah.
Well, one of the things that I often hear is that the fundamentals and kind of the lessons from those early years, the skills that you learn from learning to play an instrument like that, translate in tons of ways to your life outside of that. Anything come to mind as an immediate takeaway or lesson that you feel like you learned over the course of your childhood?
A couple reactions to that is, first off, just love for all types of music, including obviously classical music that stays and runs true today, having played the cello growing up and being part of an orchestra. They say that the cello is the closest musical instrument that mirrors a human voice, tonality and range and whatnot. So I've always come to appreciate that. But 2 reflections on my time playing the cello. One, I did a lot of competitions. So a lot of that competitive drive. I played sports when I was younger, but towards my high school years, for instance, I gravitated more towards the music side. Doing a lot of competitions, it really lit that competitive fire in me, in a sense that you're competing. But also being part of orchestra, you play a function as part of a broader team. And so just the elements that really combine and leverage a musical performance together, you come to have a deeper appreciation for being a part of a whole as well. So yeah, a couple of takeaways, I'd say. Questions that I have not been asked
I love
before.
that. Okay, well, moving from your cello experience to your professional journey, I'd love to hear a summary of your story.
So I started off my career at KPMG in their tech consulting group out in Silicon Valley, where I was advising Fortune 500 clients on large software implementation projects. At the time, I met my now wife, who started off her career with Teach for America, where she was serving second grade students in East San Jose. And as we were coming together for dinner and talking about our days, I was usually stressed about a software implementation project that was delayed a week or 2. And I thought my professional world was crumbling down. And then my wife would tell me stories of her day where she would be dealing with children who were being bullied for wearing the same clothes to school every day that started to smell because parents were making real-time trade-off decisions on putting food on the table that day and deferring laundry for a couple of days. Conversations really through her started to put things into perspective for me. I think piqued my curiosity of what I wanted to do longer term with my career. I then went on to help a friend launch a nonprofit in the youth education and leadership development space. This was the Jeremy Lin Foundation. He and I were friends growing up. And that further cemented this interest that I had of working in industries where it was more than just about the bottom line, where you're having an impact, namely in education and healthcare. So those were both driving influences for me. I eventually pursued my MBA at Georgetown, which is what brought me to the East Coast from the Bay Area. And in business schools where I was exposed to venture capital, where you have the opportunity to leverage both technology, the resources of a venture firm, you help in a small or a big way make entrepreneurs' dreams possible of the future state of certain industries. So I was very fortunate to work while I was in school for TDF Ventures, a firm based right outside of DC in Chevy Chase that was investing in enterprise technologies in edtech and healthtech, amongst other sectors. I further got introduced to Foundation Capital, which is a classic Silicon Valley-based fund where I was sourcing deals for them in the mid-Atlantic, which led to my next role at the Maryland Venture Fund. So the state of Maryland in 2015 had spun out a separate program from previously under the Maryland Department of Commerce, as it was structured as more of an economic development engine, to more of a traditional private venture fund structure. So I was brought in alongside a team of 3 others to help lead their direct investing and their fund of funds investing. So I was there for about 4 years. During that time, I was invested in on the board of a company called Mindoula healthtech company in the mental health space. And a couple of years into that journey, the CEO invited me in to join him and be the first full-time finance hire. So that was my CFO role in 2019. During COVID, we just saw this massive demand and spike in interest in mental health and behavioral health services. So the company really started to scale very quickly during that time. So we raised our Series B and our C rounds of funding, raised a debt round. We did several tuck-in acquisitions and had acquisition offers along the way as well. And so that was my real experience on the operator side of the boardroom, helping to build and scale an organization. And I was overseeing finance, HR, and operations there. A few years ago, some good friends at Sovereign's Capital had reached out as they were thinking of launching their 4th early stage venture fund. And I guess they liked my prior investing and operator experience. And about a little under 3 years ago, I joined the team there to help what we launched in terms of our 4th early stage VC fund. And now I get the privileged role of having this conversation with you, Andrew, in September of 2024. So yeah, it's been a lot of fun.
Amazing. And you guys just closed that fund. Is that right?
We did. Earlier this summer, we've formally closed and announced our Fund 4, which was a $60 million fund.
Very cool. And you guys have already been pretty active from what I understand. I think I saw 9 deals so far that are public.
That's right. We've been investing as we've had subsequent closes along the way. So we have 9 active portfolio companies, soon to be 10. When it's all said and done, we envision about a 35 company portfolio out of this new fund.
Very cool. Okay, well, we'll come back to that. Before we get to Sovereigns, I'm curious in your transition from consulting into school at Georgetown and then landing at TDF, when you were first getting into the venture ecosystem, think back with me, what were some of the key things that stood out to you as, oh, this is different from life as a consultant, right? Working with big enterprises. What were some of the things that stood out to you during that transitional season?
Yeah. During or at least my experience in consulting, you were working on projects and there would be a very clear handoff point where you would come up with a plan, a strategy, and you would hand that off to a client. You would get their buy-in, of course, but you were rarely involved in the full implementation of that and seeing the impact of that years down the road. I wasn't really even sure what venture capital was, to be honest, but when I started my business school program, Georgetown had launched a venture fellows program where for the full year, not just the summer internship, you had the opportunity to partner with an early stage venture fund. And so being at TDF for a year, you saw everything from deal origination to closing to this ongoing support that you provide as a board member or an advisor to the fund. And in VC, you have the opportunity to work with the whole portfolio, not just one company or one client. And so I saw the opportunity of the potential impact that you're able to have. And again, these are entrepreneurs that have big visions of the future. And capital is one ingredient of that, of course, to their path towards success. But I saw VCs bringing in their capital, their networks, their relationships, learnings from a particular industry, from prior investments, and all that combined in a way to support tens and dozens of entrepreneurs along their journeys across industries. And I thought that was so unique So I knew I wanted to learn more.
Love it. And how did you move from TDF to that next step? What was the story like? You got that first
Yeah.
exposure. Oh, this is interesting. I like this multi company
Yeah.
engagement structure. How did you move from there into the next
Yeah.
phase?
I often get a lot of MBA students reach out asking me, what's the best way to break into venture or land a full time role in venture? And a common piece of advice I always share is, well, imagine yourself in the seat of a VC before you're formally a VC by title, right? So that means often getting fully immersed into a region's startup ecosystem, hanging out where you know a lot of the entrepreneurs are, getting to know the players in the ecosystem, whether it's the angel investors, the institutional investors, the service providers, even the banks, the accountants, the attorneys that serve the entrepreneur market. And being around those ecosystems, you start to very quickly, at least in the DC scene, for instance, it's not a tier one market like Silicon Valley or New York, very much a tier two, but a growing and a burgeoning tier two market. You can very quickly get a sense of who the players are who are actively writing checks, all the different parts of an ecosystem that really come together to support an entrepreneurial community. So that's what I did. I started volunteering to help out as many conferences as I could, checking in folks, ushering people into their next rooms. And very quickly, I got a quick sense of who are the key investors, the check writers in the area, who are the key hubs, nodes that help support and prop up an ecosystem. And what are the emerging trends that you're seeing in the startups and the technology companies that entrepreneurs are building behind and that might get the interest of investors, for instance? All of that really immerses you in an ecosystem where there's a saying out there that your network is your net worth. I really believe that to be true. So all the contacts that you build over time, if you're really playing the long game, you'll see that those relationships that you built 5, 10 years ago, an associate at a firm 5 years ago might now be a partner at a firm today, or a banker at a startup bank, for instance, might now be the head of finance at a high growth technology startup. So yeah, really investing in relationships and your network really comes full circle, at least in the space that we play.
I love that. And I also saw from your bio that you've spent quite a lot of time serving on the different boards, either as an observer or as a director, a few different roles. I'm curious, what have been some of the lessons or the themes that you have seen from those observational
Sure.
positions?
Well, a couple of things come to mind. As a VC, and most VCs are often minority investors as opposed to majority investors, like many private equity shops are, for instance. Rarely is a VC single handedly changing the trajectory in terms of an outcome of a company. When you're investing at the stages where you're a 1%, 2%, 20% shareholder, you're still leveraging on the founding team, the executive team to drive the business forward, and you're supporting them in smaller, bigger ways. But you're taking a passive seat, so to speak, relative to the percentages of the cap table. I've seen many VCs just create more busy work for entrepreneurs. You're not adding true enterprise value. You're paying them for reports so that you can service your LPs. You're creating more work for the company, right? As opposed to leveraging some of the existing quarterly or monthly reporting that the company may be doing already, taking that and having your team do the work to translate that into an LP report for your LPs or shareholders, for instance. So most VCs end up creating a lot more work, or even if it's dysfunction on the board or administrative burdens and hassles. But what I have seen to be the most effective at the early stages, at least, is investor base that really understands the founder's journey. They know when to step in to make a key introduction or to help close a candidate during a recruiting process, or to make an introduction to a corp dev individual at a potential acquire down the line, but you want to start building a relationship early, et cetera, or share some of the lessons learned that they've seen across the industry from their prior investments in health tech, for instance. Those are ways that you can tangibly help entrepreneurs that they're oftentimes not getting their advice from their employee base, for instance, or their other customers. And so there are ways to add value. I think VCs don't always do a great job of putting yourself in the shoes of an entrepreneur and seeing how you can help them, as opposed to knocking on their door to get reports and things to service your needs as a VC.
Why do you think that is? I'm curious.
Well, I think unfortunately, the bar has been set pretty low for VCs in the industry. There's almost an inherent power dynamic where there's lots of entrepreneurs and limited capital. And if you look at some of the data, depending on the source, anywhere from 1 to 3% of new started businesses every year raise capital from VCs. So there's an inherent kind of power imbalance to begin with. And when most VCs are investing in anywhere from 4 to 10 deals a year, that's not that many opportunities, right? So there is this inherent difference there, which creates an opportunity for VCs to almost redeem that relationship with entrepreneurs, right? So I think that's what we're trying at Sovereigns, at least to try to do things a little bit differently on the institutional side. But yeah, some of those power dynamics, and it's not, and for VCs too, a lot of VCs want to maintain optionality. You don't want to say no to a deal upfront with providing hard feedback that an entrepreneur may or may not react well to. If you want to kind of hang around the hoop, hoping that maybe in a quarter or 2 quarters or even next year, maybe there's another VC that comes in and really offers a strong term sheet that you actually want to be part of a syndicate for. So why would you stick your neck out there and potentially piss off an entrepreneur with your hard feedback that many others might be thinking, but who may not explicitly say, with the hope that, hey, maybe I'll still be in the good graces of the entrepreneur down the line. So yeah, there are a lot of dynamics that exist in the industry that aren't the best, but those come into play.
It's fascinating. I'd love to hear a little bit more about Sovereigns specifically. So you mentioned that you all are trying to redeem this relationship with the entrepreneur. I'd love to hear a little bit more about the Sovereigns thesis and how you go about doing that.
Yeah, thanks for asking about that. So Sovereigns Capital as a firm, we were started 12 years ago. A couple of the co-founders, Henry Kastner and Luke Rausch, both entrepreneurs who had been through the entrepreneurial journey. Henry Kastner in particular, he was the co-founder of a company called Bandwidth. Bandwidth provides a lot of the voice over IP infrastructure that actually powers the underlying technology behind Zoom, Amazon Alexa, even the 911 dispatch system. This company was started back in the 90s. And like many other entrepreneurs at the time, Henry and the team went out to Silicon Valley and pitched all the VCs as to why they should invest. He had 40 first meetings that all led to second and third meetings, as VCs were very interested in the technology and the momentum of the business. In those subsequent meetings, Henry wanted to shift the conversation to what he felt was a long-term competitive advantage of Bandwidth, which was this culture that he was stewarding. Henry, as a Christian guy, that largely influenced the values of the organization. And so for the core 4 key pillars at Bandwidth were faith, family, work, and fitness. And you saw that play out in various ways. There were midday lunch running clubs where you could exercise with your colleagues and you're encouraged to do so. There were sometimes Bible studies and other groups that met where you could find affinity groups of your various shared backgrounds. At 6 o'clock, everybody was sent home, kicked out of the office so that they could have dinner with their family and friends. If you needed to work from home later on, you could do so, but everyone was out. If you were on vacation with your family, there was an email ban embargo that was placed on you. You could not contact anybody at the company and vice versa. If you did, when you returned, you were asked to stand on the conference room table for a public shaming. A little tongue in cheek, but to make a point that, hey, this is your time to recharge and to be present. And that will actually make you a better colleague for when you return. So there were big and small ways that there was this real emphasis on bringing your whole authentic self to work. And a lot of the VCs out in Silicon Valley heard this and they looked at him and said, that sounds nice, but that's not what our industry is really known for. We're backing the hard charging, pressing entrepreneurs that are grinding it out, that are working 90, 100-hour weeks. And sure, that's one way to do things. But in Henry and team's mind, that's not what really human flourishing was. So they were unsuccessful in raising that early stage venture capital funding. So it took Bandwidth longer than some of their other competitors. But of course, in the latter years of growth, Bandwidth is a publicly traded company now on the NASDAQ. All the investors wanted to pour as much capital into the business as possible later on. There are a couple takeaways and reflections for Henry. One, that there has to be other faith-driven entrepreneurs like me that want to build big businesses for great return, market rate returns. And number two, traditional capital sources probably don't know what to make sense of this type of entrepreneur and has a strong emphasis on culture. So Henry and a couple others banded together to start Sovereigns Capital 12 years ago with this thesis of backing early stage entrepreneurs that want to build great businesses for big returns, but with an eye towards human flourishing through how they care and reflect love of neighbor through their products, through their services, and how they care for all stakeholders in a business. And so that thesis has played out over the last 12 years, where today we're investing out of our 4th early stage fund, which is a $60 million fund. And given the success of the team over the years, we added some additional capabilities. So we have a separate investment team that runs a private equity fund, a separate team that runs a real estate fund, a public equities fund, and a fund of funds as well. So 5 core investment strategies a global team of about 35, 36 that supports what we do. But all of our strategies have this common thread of partnering with entrepreneurs and business owners that have an eye towards human flourishing that reflect love of neighbor through how they carry out their business principles and leadership. So that's a little bit about what we do.
Phil, I wonder if you could give an example or two, maybe from your current Fund 4 portfolio of a company that does this well and maybe how you all went about evaluating that opportunity.
I'll share two examples, one from our current fund and one from a prior fund. We're early investors in a company called Grab. Grab is the largest technology company in all of Southeast Asia. They're the Uber equivalent, so to speak, of Southeast Asia. Anthony Tan, he's the CEO there. He actually started the company hoping to combat all the violence against women that was happening in the taxi cab system. He went to HBS for business school and he returned back home and started this company with that goal. And he quickly realized the market momentum for on-demand kind of transportation and delivery services. So he started to scale very quickly. This is around the time that Uber had started raising its war chest of funding, and they were expanding now out into Southeast Asia. And they went head to head for a few years to try and own that market. Over time, Grab started attracting all of the Uber drivers to their platform. In a lot of the interviews as Grab went public on the NASDAQ, analysts ask Anthony, how are you able to outcompete? How did you attract all the drivers from Uber? And Anthony very straightforwardly says, I have a personal relationship with Jesus Christ that calls me to love my neighbor. And one of our core values in our business is to outserve the competition. So everything from calling, even simply calling your drivers, not your 1099 contractors, but calling them driver partners, to going out of your way. For instance, during the pandemic, Anthony, when it was very difficult to access COVID vaccines in the region, he went out of his way to provide vaccines for drivers and their families. Regardless of your stance today on what we've learned since, that was an expression of love and service that he didn't need to do. In fact, it was very difficult to do in Southeast Asia in the early onset of COVID. And so a lot of these resources and tools that are provided to their drivers attracted Uber drivers, and Uber eventually retreated from that market and Grab acquired their IP assets. And it's a huge success story for Southeast Asia, and it's led by an incredible faith-driven entrepreneur that wanted to, of course, build a great business, but do it with an eye towards human flourishing and creating cultures that really care and reflect love of neighbor. So that's an example in Southeast Asia. We invested in a local company in Southern California called Pravida, started by a data scientist and a nurse practitioner who were caring for a loved one that unfortunately passed from cancer. As they were providing care, they lost weeks and weeks and months trying to find the right specialist for that particular type of cancer. Eventually, when they got to the right doctor, the doctor said, if only you had found me and come to me weeks earlier, we would have had a couple different treatment options. But unfortunately, at this point in time, we've just run out of time. And these two individuals were heartbroken. They had spent lost weeks and months as a result of delayed lab results that were sent to the wrong office. They weren't notified, so they were just waiting and waiting when they could have been taking action. They were being routed to the wrong specialist. The prior records were not being transferred over. And there's no reason why technology can't assist in optimizing a care plan and pathways for those dealing with cancer, often in the darkest years of their life. So they started this company, Pravida, that works with EMRs and clinicians to optimize care plans for those dealing with cancer. It supports the doctor, so it doesn't take away the work or the dignity of that providing direct care. But if, God forbid, Andrew, you have a certain lab diagnosis that needs to be sent tomorrow after your exam, and the clinic isn't notified, then there should be an immediate alert that says, hey, what happened to this lab result? Andrew needs to come in for a follow-up or needs to be routed to this correct number, et cetera, to determine the best route of care. So that's another example of companies that are using technology for redemptive purposes that are driven by a deep motivation and desire to love your neighbor, so to speak, through technology startups.
Amazing. So it sounds like there's quite a bit of variety in terms of industry, sector, things like that. Could you walk me through how do you diligence this stuff, right? How do you evaluate that? I'm sure you get this question all the time, but walk through that process.
It's tough to do so with a quick 30-minute initial Zoom. You don't always get to the heart of the story. So it takes us a little bit longer, but we all ask a lot of open-ended questions of, tell us your story. What were the key inflection points that influence your leadership style or your personal view on growing and scaling a business? How do you view technology being used for redemptive purposes? We meet all of our entrepreneurs in person. If we have the opportunity to, we'll invite their families or their spouses out to break bread with us. We think that's important, recognizing all the other individuals that help allow an individual to work and spend a lot of long hours and late nights, for instance, working on an early stage startup where you're wearing many, many hats. We try and get a sense of culture at an organization by talking to not just the founders, but other individuals and mid-level managers or even employees at an organization. We look at external recognition when possible, Glassdoor reviews, a great place to work. We look at recruiting cycles, retention cycles, the average tenure of employees. So all of that holistically gives us a good sense of the motivation of an entrepreneur. And hopefully it means more than, oh, we're looking to scale to a certain point in 3 years and then exit the business for a quick flip. Not that that's wrong. That's just outside of our scope. We're looking for motivated founders that are building because they feel like this is their life's calling or purpose at this point, and through their gifts and experiences and talents have led them on this journey that culminates in this startup venture. And of course, we get to hopefully take a small part in joining them and supporting them in that path.
What are some of the big questions that you get from LPs? What are the things that they tend to poke on as common
Yeah.
misunderstandings about the strategy
Yeah.
that you all are running?
A lot of times folks ask if we're in this camp of kind of impact investing, investing in social impact types of companies, which we aren't explicitly. Naturally, by our mission, we end up investing in companies that may fall into that, but we're not impact investors, for instance. We're not pursuing concessionary returns. We believe that this overlap of faith-driven entrepreneurs with thriving cultures can deliver market rate returns and above market rate returns at that. So our venture funds, for instance, we're targeting a top quartile kind of performance in all of our venture funds. But we get that question often. We get the question of what is it like how big is that market? There isn't a directory, so to speak, of all of these faith-driven entrepreneur types out there, right? So we have to dig a little bit to find where those entrepreneurs are, those networks, and stay top of mind, for instance. Those are some of the more common questions that we get. As we grow larger as a fund, as a firm, our LP base will naturally become a lot more institutionalized with larger check sizes. So having more robust diligence and screening processes, kind of reportings. We're now an RIA as of a couple years ago. So that comes with a lot of tight controls and documentations as we're reviewed by the SEC every year and things like that. So we continue to evolve as a firm, but those are some of the early questions that we get.
You mentioned one of those companies, Provida, in the health tech space. I understand health tech and ed tech more broadly are categories that you're particularly interested in and obviously have some background in. I'd love to hear maybe some quick thoughts on trends or what you're seeing in that space in recent years.
Yeah. EdTech has taken a bit of a beating in terms of venture funding. A couple dynamics here at play is the buying cycle is very difficult, whether it's the schools or a district. You have to catch them at the right window, usually in the summer before the new school year starts. And if you miss that, you often have to wait the next year. And as many people know, schools districts, they're not the most resource flush customers in terms of spend. So it becomes a tricky one to navigate through. There also haven't been too many kind of big venture type of returns over the last 5-10 years, I'd say, in that tech space. So all of that has contributed to some of the funding that's gone from an institutional perspective, dropping off in that tech space. On the healthcare side, healthcare reflects approximately 20% of GDP spend. It's a very complex, but also massive market. There's lots of misaligned incentives and players that play in healthcare, whether it's the payers, the providers, the patients, the software application layers in between that intermingle with different parts of the ecosystem. So you have to really align incentives, not just financially either, in terms of outcomes and financially, and demonstrate ROI. Now, I'd say currently we're seeing a lot of momentum in ways that AI can be used in specific applications to address a lot of the gaps that we're seeing in healthcare. A couple years ago, it was a lot of these foundational models that we were seeing in the AI space. But as the space continues to mature, now we're seeing very specific solutions that are addressing real dollar appointed pain points in the healthcare space as customers are now thinking through, okay, how do we think about ROI on the spend that we're allocating for AI? So we'll continue to see a lot of innovation happening there. And if you're an experienced entrepreneur that really understands some of the incentives, the ways to navigate through the sales cycle in healthcare, I think there's massive opportunity.
You mentioned angels a little bit earlier. Your journey into venture involved showing up, getting to know the angels around you. How does Sovereigns interact with angels on a regular
Yeah.
basis?
Angel investors are an incredibly important part of the venture and the startup ecosystem. Most, if not all, of the companies that most venture funds invest have been supported and funded by angel investors. Often in that friends and family round or that pre-seed round, angels play a huge role in that. And that's where you see ecosystems like Silicon Valley really thriving. There's this kind of flywheel happening of the entrepreneur's journey in the startup ecosystem where a company does really well, there's a great exit that often creates the next generation of entrepreneurs who have some cash now in their account that they can take risks of going out and starting their own venture. So they become check writers now and entrepreneurs starting their next things. That allows companies to hit certain milestones before the VCs come from a more of an institutional perspective. So angel groups are a great source of deal flow and referrals for us. And we love building relationships with different groups, angel groups around town. And so for those of you that are just starting to think about angel investing or asking yourself, how does that an angel as an individual or even as a group play into the larger startup ecosystem? It's a key part of it. Without it, a lot of venture funds wouldn't touch companies because they won't have hit those key milestones that reflect some of the metrics and KPIs that VCs look for. What I am encouraged to see are different types of angel groups pop up around the country. In Dallas, you have the Ambassadors Impact Network, which I know you're involved with. In Austin and in DC, you have a network called the Potomac Angel Capital. So there are different pockets now of angel groups that are uniting under a certain mission or a type of investing, not just all tech, for instance, that we're starting to see all across the country, which has been encouraging to see. I was just at a conference where there's the first Catholic angel group being set up right now, which I had just learned about. So that's pretty neat to see these different affinity types of syndicates. I think it's best when you're starting as an angel to learn in a group setting. Often when you hear a pitch from an entrepreneur, if you're anything like me, you get really excited, right? And you fall in love with the vision and the mission of the organization. But sometimes you need to take a step back and look at the business more holistically, the addressable market, the technology, the competitors in the space, for instance. And when you're talking about a deal with other angel investors that might have different domain expertise or experiences working or supporting for startups, we'll have a robust discussion of what others saw as a strength or a weakness of an opportunity. And that's where I think angel groups really come into play. It's often the discussion that happens after the entrepreneur leaves, where you're debriefing, talking about the pain points or why you're excited and this might be a winner. A lot of the learning happens there. So if you're an angel investor just starting out, I would encourage you to learn in a group setting like that because you just get a lot of reps and you get into the mindset of other institutional types of investors who will be funding these companies in the next stage of growth.
Phil, any other lessons or comments that are top of mind for you lately?
A couple things. I will share one on the angel side and then I'll share one on the personal side too, is when you're just starting out as an angel or even as a VC, you need to see a lot of deals. If you only see 10 deals, you might think 3 of them are great. If you see 1,000 deals, those initial 3 might not be so great. So you need a lot of rep to see what makes a founding team or a market opportunity or a technology truly unique and the opportunity to create a defensible moat. So I've been in the venture kind of space now for 11 years. And you just every subsequent year feels like I'm just humbled by the opportunity where it's not a right that you're on somebody's cap table. Only to be invited to be on a certain cap table, right? For entrepreneurs and founders, it's often their life's work that has led them to this point where these are really intelligent, successful people, right? They can make a very comfortable living working at a big corporation. And yet they've chosen to oftentimes take less cash comp to really go all in on a specific business idea. And for you as an investor, as a supporter to be a part of that journey, that's really special. And now having been on the operator side of a business, it is really difficult. What you see in a quarterly board meeting or a monthly update email, it's not even 10% of what really happens behind the scenes day in and day out of running a business. The highs are very, very high and the lows are very, very low. So to have an empathetic view towards what company building looks like, especially in the very early days where you often don't have a fully fleshed out management team, where you don't know if you have product market fit or even if you'll be around next year, right? With your funding or your revenue, for instance, that's a special opportunity you have as a supporter to join in alongside. So we're always grateful, deeply grateful for entrepreneurs and looking for ways that we can get involved in unique ways. Lastly, I'll mention one small way that we're trying to do that at Sovereign's Capital, in light of what I just shared, is we started internally. All employees at Sovereigns have the option voluntarily to contribute to this blind pool of capital. We call it a committed partnership fund that we make available for all of our portfolio companies and their employees for unexpected life events that might happen. When you're joining a company at a startup, you're taking equity, but less cash, for instance. So if you have a tragedy or an unfortunate event in your family, for instance, that can be devastating for you. And so we make this pool available for all of our employees to access. If you need some help paying bills, if you have to address a medical emergency, you know that your investors at Sovereign's Capital have this resource available to you and your employees, recognizing that early stage company building is very, very tough and is oftentimes not lucrative, especially in the early years. And again, this is a very small thing, but a different dynamic that hopefully shows and reflects love of neighbor, even from an investor base down to the underlying companies in their portfolio. So I think in big and small ways, everybody can do something unique in their circumstance to help address startups and the entrepreneurs in their journey. And that's something that's been on our mind here as a firm as of late.
Amazing. I think that's really powerful. Well, Phil, thank you for your time today. This has been such a pleasure. I look forward to sharing this and reconnecting with you again soon.
Thanks so much for having me on.